Welcome to Iron Financial. This is the only channel dedicated to one thing: forging a stronger portfolio. We don't chase hype. We don't follow the herd. We put companies through a stress test, we analyze their blueprints, and we cut right through the market weakness to find true structural strength. And today, believe me, we have a titan in our sights.
Yeah, we are talking about RTX. For those of you who don't know, this is the world's largest aerospace and defense company. A true heavyweight. They just dropped their full year 2025 earnings and, the headline numbers are making some serious waves. Our job today is to go way beyond the press release, to get our hands dirty and figure out what's really going on inside this industrial fortress.
Okay, let's just cut right to the chase here. This is the core question, isn't it? Every single quarter, management teams roll out these glossy, polished reports telling you how fantastic everything is. But we're here to ask the hard questions, the ones they don't want to answer. Are we actually looking at a financial structure that's built from solid steel, or is this just a pretty facade with some really serious cracks hidden behind the drywall? That's what our viewers are paying us to find out.
That's exactly right. And to get that answer, we're going to put this entire company through a rigorous structural stress test. First, we'll ask the big picture question. Is this thing even built to last? We'll start by checking the top-line revenue. Think of that as the outer walls of the fortress. Then we are going deep inside the engine room to inspect its core, load-bearing pillars. After that, we're going to examine the foundation itself, because let's be honest, cash flow is king. Then we'll analyze the blueprints for the future with their absolutely massive backlog. And finally, we're going to deliver the Iron Financial verdict. Let's get to work.
All right, let's dive right into Section 2, the top-line revenue check. Every single analysis we do starts right here, at the top. We're looking at the company's total sales. This is the first and, the most basic measure of corporate health. Is the company actually growing, or is it stagnating? This is what tells us about the overall demand for their products and the real integrity of their position in the market.
Now, what's really interesting about this slide is just the sheer scale of the operation and the growth that they're showing. I mean, look at that top line. Full-year sales clocked in at nearly $89 billion. That's a 10% jump from 2024. Now, that's not small change, folks. That's $8 billion in brand new revenue. On the surface, this looks like a powerful engine that is absolutely firing on all cylinders. This is the kind of top-line strength that we're always looking for.
And this right here brilliantly illustrates the quality of that growth. 11% organic sales growth. And let me be perfectly clear about what that means. This isn't growth from just going out and buying other companies. No, this is pure, unadulterated expansion. It means they are selling more of their own products, more of their own services. This is the real muscle of the company flexing its power, showing fundamental raw demand strength across their entire portfolio.
Hang on a second. 11% is a great number, okay? I won't deny that for a second. But a fortress is not built on a single pillar, no matter how strong you think that pillar is. A 10% overall growth rate could easily hide a lot of underlying weakness. So, is one division doing all the heavy lifting while another one is literally crumbling? And is this profitable growth, or are they just chasing revenue at any cost? Before we even think about declaring this structure sound, we have to look at the individual load-bearing walls.
You know what? That's a fair challenge. Averages can be incredibly deceiving. So, let's do it. Let's break it down and move on to Section 3 of our stress test. We are going inside the engine room. See, RTX is built on 3 massive business segments: Collins Aerospace, Pratt & Whitney, and Raytheon. We're going to put each and every one of them through its own individual stress test to see if they can hold up under pressure.
Okay, we're going to start with Collins Aerospace. This is a massive business just on its own, making pretty much everything from avionics and landing gear all the way to cabin interiors for both commercial and military aircraft. It's a foundational piece of the entire RTX structure.
Looking at these fourth quarter numbers, what we're seeing is steady, if not, spectacular performance. Sales are up a respectable 3%. It's growing, it's stable, but steady. I'm seeing a potential hairline crack right here. Look closer. Sales are up 3%, fine, but their adjusted operating profit is only up 1%. That's a problem. And look at the adjusted return on sales, or ROS. It dropped from 16% down to 15.8%. Now, it's only 20 basis points, but it's moving in the wrong direction. This tells me their profitability on each and every dollar of sales is shrinking. Now, why is that? The report mentions things like higher tariffs and the impact of divestitures. But this is exactly the kind of detail that worries me. It is a clear sign of pressure.
Okay, point taken on Collins. Let's move to the second pillar, Pratt & Whitney. Now, this is the heart of the machine. This is the engine maker. They power a huge portion of the world's commercial and military aircraft fleet, and that includes the F-35 fighter jet with its incredible F-135 engine. This is an absolutely critical, high-tech segment.
And right here, the top-line story is, well, it's explosive. Just look at that sales number for Q4, up 25%. That is a massive surge in demand. The report says it's being driven by both commercial engines, especially aftermarket parts and repairs, and a 30% jump in military sales. This is where a huge chunk of that 11% organic growth we talked about is coming from. This pillar looks incredibly strong.
Whoa, 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 not so fast. Strong or just big? This slide shows the core tension here in plain English. And this is more than a hairline crack. This is a flashing red warning light on the dashboard. You're telling me sales rocketed up 25%, but at the same time their adjusted margins got absolutely crushed, falling 130 basis points? That's a massive disconnect. And this isn't just some simple cost issue. It exposes the fundamental high-stakes game they're playing in this industry. It's the classic razor and blades business model. You sell the engine, the razor, at a super low margin, sometimes even at a loss, just to lock in decades of high-margin service and spare parts contracts, the blades. So when you see sales growth this high, driven by new engine deliveries, it can actually hurt your margins in the short term. The crucial question is, are they just buying revenue, or is this a calculated investment in future profitability? To me, this looks like a pillar that's buckling under the weight of its own strategy. This is the single biggest vulnerability we've seen so far.
All right, you've definitely highlighted a serious tension point at Pratt & Whitney. That margin compression is something we absolutely have to watch. But let's look at the third and final pillar before we pass any final judgment. Let's talk about Raytheon. This is the pure play defense side of the business. We're talking missiles, we're talking air defense systems like the Patriot and advanced radar. In today's geopolitical environment, this is a critical segment.
And this is where the bull case gets its strength back. This pillar is rock solid. Just look at these numbers. Sales are up a very healthy 7%, but the real story is the profit. Adjusted operating profit is up an incredible 22%. And look at the most important metric on this slide. Their adjusted margin expanded by 140 basis points. They are making more profit on every single dollar of sales. This is the star performer of the group. It's efficient, it's profitable, and it's growing. Raytheon is doing the heavy lifting right now, providing the steel reinforcement for the entire structure.
Okay, Raytheon looks great. I'll give you that. But we've been talking a lot about sales and adjusted profits. Let's be honest, those numbers can be manipulated with accounting tricks. There's an old saying on the street, sales are vanity, profit is sanity, but cash is reality. So let's move to section 4 of our stress test. Cash flow is king. If you really want to know the true health of a company's foundation, you don't look at the income statement, you look at the cash flow statement. Let's see if RTX is actually generating cold, hard cash.
This right here, this is the slide that should get every single investor's attention. This is the bedrock of the entire company. In 2024, RTX generated about $4.5 billion in free cash flow. A solid number, no doubt. But in 2025, they generated $7.9 billion. That is a 75% year-over-year explosion in free cash flow. This is not an accounting trick. This is cash in the bank after all the expenses and all the capital expenditures are paid for. It's the money they can use to pay dividends, to buy back stock, or to reinvest in the business. This, my friends, is the ultimate sign of a durable, powerful financial foundation.
And guess what? It wasn't an accident. The CEO, Chris Collio, says it right here in his own words. This was the result of a direct focus on operational performance and execution. Management made generating cash a top priority, and they absolutely delivered. This quote tells me that the leadership team understands what truly matters for building long-term value. Execution is everything, and when it comes to cash flow, they executed perfectly.
I have to admit, that cash flow number is impressive. Very, very impressive. But I have to bring this up because it's something we've mentioned a few times now. That word adjusted. Adjusted EPS, adjusted operating profit. What exactly are we adjusting for? Well, this slide breaks it down. Companies use these non-GAAP figures to show you what they consider their core performance. They strip out things they see as one-time or non-recurring, like restructuring costs or costs related to acquisitions. Now, this can be useful for analysis, but it's crucial for you to remember they are excluding real costs. Restructuring costs real money. These adjustments almost always paint a rosier picture than the official GAAP numbers. It's not necessarily a red flag, but it's something every savvy investor needs to understand. Look at both numbers and always know the difference between them. That is a very important point on accounting. Awareness is key. All right, now for Section 5. Let's pivot from what the company has done to what it's planning to do. The past is important, sure, but we invest for the future. And the best way to see a company's future is to look at its backlog. This is the blueprint for future revenue. These are the fortress walls they've already built.
Just look at that number, $268 billion. Let that sink in for a minute. That is more than 3 times their total annual sales, already locked in as future work. This is a formidable moat around the business. It provides incredible visibility into the future and a massive cushion against any potential market weakness. While other companies are out there fighting for new business every day, RTX has years of work already lined up and just waiting to be done. This is what a fortress looks like on paper.
Okay, the size is undeniable, but as always, the composition, what's inside, is what really matters. So let's break down that $268 billion. 60% of it, or $161 billion, is on the commercial side. The other 40% is defense. Now, that 60% commercial exposure has been fantastic during the post-pandemic travel boom, but it also means RTX's future is heavily tied to the health of commercial airlines. If we hit a major global recession and travel demand plummets, that part of the backlog could be at risk of delays or even cancellations. Having 40% in the more stable, government-funded defense sector provides a good balance, but it's a risk profile that investors need to be very comfortable with.
That's a valid risk assessment, for sure. So let's look at how management sees the immediate future. This is their official guidance for 2026. They're projecting continued growth pretty much across the board. Sales are ticking up to the $92 to $93 billion range, adjusted EPS is growing, and look at free cash flow. They expect it to grow even further, to over $8.25 billion. This is a picture of steady, continued forward momentum. It is. But I see one number here that gives me some serious pause. Look at organic sales growth. They just posted 11% for 2025. Their guidance for 2026, 5 to 6%. That is a significant deceleration. It strongly suggests that the massive post-pandemic recovery surge might be leveling off. It's still growth, absolutely, but it's a much, much slower pace. So, is the period of explosive growth over? That's a key question for anyone thinking about this stock's future potential.
We've run the stress test, we have inspected the pillars, we have checked the foundation, and we have analyzed the blueprints. Now it's time for our final section, the final verdict. Based on this Q4 report, is RTX an opportunity to build a stronger portfolio, or is it a potential trap for unwary investors?
The bull case, the argument for strength, is incredibly compelling. It's forged from pure iron. You have an absolutely explosive 75% increase in free cash flow, which is the ultimate sign of financial health. You have a massive $268 billion backlog that acts as a fortress wall, giving you years of revenue visibility. The Raytheon defense segment is firing on all cylinders, with expanding margins and really strong growth. And all of this is built on top of a year of double-digit 11% organic sales growth. From this perspective, RTS looks like a well-built, incredibly durable industrial powerhouse. But you cannot ignore the cracks in the armor. You just can't. The bear case is just as important. There is significant and undeniable margin pressure at Pratt & Whitney. That disconnect between rocketing sales and falling profitability is a major, major concern. You have the persistent questions around the adjusted earnings, which, let's be honest, paint a rosier picture than the GAAP reality. You have a clear forecast for decelerating growth in 2026, which could signal the end of the easy wins. And finally, a $268 billion backlog is great, but it also represents massive execution risk. They actually have to deliver on all those projects on time and on budget, which is no small feat for a company this size.
So there you have it, the bull case and the bear case, all drawn from the exact same set of numbers. It's a titan of industry with a fortress-like backlog and just incredible cash generation. But it also has clear stress points and some really serious questions about the quality of its growth and its outlook for the year ahead. We've given you the analysis, we've shown you the strong pillars, and we've pointed out the potential cracks. Now the final decision rests with you. At Iron Financial, we give you the tools. It's up to you to forge your own path. Thanks for watching.